Hello and welcome to Options Guide TV. My name is Brian Overby, the author of the Options Playbook and your host for about the next 25 minutes here on Options Guide TV. All right, so we have a big day. 15% of the companies are announcing earnings. The S&P 500 index, I should say, are announcing earnings this week. And one of them is Google, and they're announcing tonight. We have a position on in Google. We have a open wing butterfly. Google has, I guess, chopped a little bit. It's up today. It was down since we put the trade on. Trade still looks just fine, riding it into earnings. And then we can do a short-term trade on Google. We added an extra week in the initial trade, but we're going to come back and look at another open wing butterfly just using the Friday expiration, which is always speculative, but it's interesting when you're looking at butterflies just because of the time decay issue and the decrease in implied volatility. If you write on your forecast, is what you want to happen with an open wing butterfly or any other type of butterfly. But also ConocoPhillips is going to be announcing here August 6th, actually, before the open. And I wanted to put on a trade in ConocoPhillips to start with that is going to be a diagonal spread. Now, I like ConocoPhillips, and we're going to start by looking at this chart. So let's run over to the Trader Pro software. And I'm going to highlight where my crosshairs are. This was a call out by someone in one of my webinars that I do not only here on Options Guide TV, but on different platforms. And the momentum here on ConocoPhillips is strong, and it's looking really good heading into this earnings report. And I wanted to highlight, and this was the beginning of the week, that there's some money flow coming into ConocoPhillips, seeing some unusual option activity all on the call side of things. And right here, we see this was a solid area of support. And we see the gap break up, come down and touch, and then take off, come all the way back down and touch, take off, come back to, and it did this 3 times before, or 4 times, I guess. This was, well, at 5 times. 1, 2, 3, 4, 5. And a lot of times when that happens, every time it touches, it's harder and harder for the support to hold. And then we got the breakdown. Well, guess what? We also had to break back up. I think the path of least resistance is towards the 121 level. There's a defined channel here that obviously this period of consolidation. And now we have more issues in the Middle East, once again, that don't look like they're going away anytime soon. So we had a spike up in oil. Energy stocks in general have all done fairly well because of that. They sold off, and not necessarily because of the fundamentals of the company, only because of what's happening with oil prices and the foreseeable future. So I like ConocoPhillips going into earnings, and I want to get long a call option by doing a diagonal spread. Now, ideally, I would like to do this last week, but I just thought of it today. And this came on my radar with this breakout right here, with the second candle that closed near its high, the 116 level. And now we have a nice momentum day today. I still think I want to do this trade. Now, this trade, if you put this trade on, very short term, very volatile, it's around earnings. We're going to buy the expiration that contains the earnings, and we're going to sell the nearer term expiration to try to generate some income. And we're really hoping the stock doesn't blow through that strike. And the last time we did this trade, it kind of nipped me, I should say, inside my webinars, is I did it on Intel, because Intel had a very strong move to the upside. They were heading into earnings. They didn't wait. And what happened was the trade turned out to be a flat trade, but Intel took off. And it was a frustrating trade in that we did a diagonal trade, but the stock moved way too much prior to the earnings report. And if you had just bought the call out long, you would have been up about 100% or triple that maybe. So just want to keep that in mind. This isn't Intel. This isn't, U.S. government looking to add to be part owner in in the semiconductor company. So we're going to do this in ConocoPhillips. So here we go. And Intel's announcing earnings tomorrow too. So here we go. We're going to look at the July 31st, 9 days away, 122 strike call. So it's important that it's the 122 strike call. August 6th is the earnings. You see the jump up in implied volatility. So it's a little bit counterintuitive in that we're going to sell the lower vol and we're going to buy the higher vol. Now, the anticipation would be that this vol would increase as that earnings report approaches, as that potential earnings report approaches. But you see the historical vol is right around 35%. So I think there is a good solid chance that ConocoPhillips could jump up in implied volatility over the next 9 days and start pumping up this vol on the expiration that contains that earnings report. What we need to happen, though, and if you look at the chart here, 122 is that resistance level right here. Okay, so there's some method to my madness. We don't want it to get to 122 over the next 9 days. So right here, I think is that if there's going to be a stopping point in this move up in the underlying stock, it would be right around this 122 level. Right there, it goes all the way across. Actually, this is where that stopping point was over here. So a very interesting spot on the chart. And so we're selling that strike. Now, the shorter term option contract, the delta or the gamma on that option, if it gets in the money, will lose you money faster than your longer term option. And if that option contract gets in the money, gamma will explode delta. Delta will become 1 as expiration approaches. And you just want to be aware of that. So what I like to do is actually go a little bit more in the money on the option contract that I'm buying. And we're going to buy the 121 strike. So we're going to run over to the August expiration now. And we're going to buy the 121 strike. Now here, we're a little bit more. It's not a ton because we're talking about $119 stock, not an extremely expensive stock. But 45 is the delta on this option contract, which is going to be a little bit higher than the delta on this option contract, which is 36. So net, we're net 10 delta, and actually shows you right here. I kind of forget that that's down on the order ticket sometime. So if the stock goes up 1, this position should make $10. If the stock runs to 122, don't expect to hit a home run, but you want to take the trade off. You don't want this option contract to get in the money. You're hoping that it will expire before that happens. Good morning. Good morning, Kevin. Good morning. Thanks for popping in. And it's a very inexpensive trade. So if you're doing this trade and it's your first time doing it, you can't fall asleep. You can't get assigned on the short-term option. And so to me, diagonal spreads are more advanced than even butterflies, even though it's 2 legs. It's the fact that you're dealing with 2 different expirations. And so the risk of early assignment or not even early assignment, of assignment on the front month while you're still long the back month, that is a true risk. But around earnings, they're really interesting, especially if you see a stock that you like and you like the movement on that underlying stock. I mean, we're up $2 today, 1.72%. But I haven't looked at where oil is at right at this moment. But I wouldn't doubt that it is starting to climb higher. So take a peek at that, see where we're at. And with this trade, we're gonna it's literally called a diagonal. So let's run over to the what if calculator, and it is an alternative to a long call spread. It looks a little bit, but you got this little weird wavy thing, and that's what happens when you have 2 different expirations. So if we do this, we'd love it to go to 121 1.99, right? And expire on July 31st, right at that strike. We're not going to spend a lot of money because we're actually bringing in some decent premium. Oh, here it is. So we're bringing in $1.44 on that short-term option, and we're paying $2.94. So my goal here is to be long a call heading into earnings, and I want to do it on a cheap basis, which is hard to do when there's earnings, right? So this is what the plan is. I wouldn't have to run up we needed to stop from running up an extra 2 points here. We've had some momentum. We wanted to just slow down and then ride this long call option into the earnings report. And that's the ultimate goal. So this is a diagonal spread. It is, and the reason why it's called a diagonal spread, and if we run back to the trade, all these names, I think the more official name comes from the way the quotes are down on the floor of the Chicago Board Option Exchange. And if I'm doing a diagonal spread, that means that I'm looking at the July 31st expiration and then the August 7th expiration. So I'm looking diagonally on the board. I'm looking at one strike versus the other strike. So ideally, my eyes are going diagonally, if you will, and that's why it's called a diagonal. The other spread that we talked about is a long call spread. That's the more generic name, but that would actually be called a vertical because of that. If they were the same strike price, it would be called a horizontal because your eyes would be going horizontally from this expiration to that expiration, and they would be the same strike. So your eyes don't move at all. And those are the more, I guess, technical names, if you would. And they came from people standing in the pit down on the trading floor and quoting these advanced trades. So in this instance, we're at 121, 122 we're going to sell. We're going to make this at 150, 143. Let's take it. Let's go in, we'll say 145. And I will give you an official readback here. So let's scroll this up a little bit so we can see both of these expirations. All right. Boom, and boom. All right, we'll just do it that way. All right, so ConocoPhillips is going to be announcing earnings on August 6th before the open. COP is trading right now at $119.44. It's up $1.94 on the day. We're going to go out to the August 7th expiration, 16 days away. This option contract expires the day after the earnings report. And we're going to buy the 121 strike call. We're going to be long that call option. Now we're going to sell something to try to pay for it. So we're going to look at the July 31st expiration, and we're going to look at the 122 strike, 1 point higher. We're going to look to sell that option contract that only has 9 days remaining to expiration. This creates what's called a diagonal spread. We're going diagonally on the quote boards, and we'll have 2 different expiration dates that we'll have to deal with. We're hoping the underlying stock goes to 122 and then stops and doesn't go above and beyond before the July 31st expiration, and that front month option contract expires. We then want to be just long the August 7th contract, 121 strike, as we head into earnings. Our goal here is to be long an option contract into that earnings report at a much lower price than just buying it outright, which is at the midpoint right now at about $3. So we're going to send this down to the trading floor at the midpoint of $1.45. Boom goes the dynamite. Our diagonal spread has been sent. Now let's go back and look at our portfolio, see what we got in Google. These deep in the money call options these are just long call options, and those are from Fundamental Friday. We're going to look at our butterfly here. We bought the 360, sold the 380, and then bought the 390 in this instance. And right now it's trading for $3.71. Wow, we're off a little bit more than anticipated. Vol came up. I guess we're outside of the range. When we entered this trade, We got this trade done for what did we get it done for? $4.70. So we're off $1 on this trade right now. We're going to still ride it into earnings. If the underlying market finishes above 390, okay, we got to flip this or it's not going to look. We got to go buy, sell, buy. And we're going to send this to the what if calculator. Stock is right here, 348. We are long this option contract from, I'm sorry, the 360 option contract all the way up. We went really wide up to the 380. And then we stopped short on the short spread inside the open wing butterfly and bought the 390. That means that anywhere from 360 to 380, that's 20 points. And from 380 to 390, that's 10 points. So this has to trade for $10. 20 minus 10 is 10. And we're paying right now 366 to put the trade on. When we did the trade, it was 470. That meant that our maximum that we can make if we blow through the strikes to the upside would be $5.30 on the upside. Now let's go back and look at a new butterfly. And we're going to make this one very speculative. We're going to go 2 days out. And we might stay at the same strikes. Let's see where the expected move is at. So on the expected move, we have the extrinsic value at 12 and so 13. We'll say $26. 26 plus. We'll say 76, 75, about the 375 strike, and that's a 24 delta right now. That's where the expected move is at. We're long the 360 on our longer term option. Let's try the look at the July 4th, 24th expiration. 2 days away. Man, we have a lot of expiration. So we want to be on the 24th. That's Friday, 2 days away. Now this is a little bit different, and there's a few of these where we're starting to get dailies. I'm not a big fan of having an expiration every single day. I look at a stock, first of all, like GE Vernova. I really wanted to trade that, but they have weeklies in there, and the markets are just ginormous. And the stock is down $65 today. I looked at doing a trade, but you have 5-point wide bid-ask spreads on the nearest term expiration at the money options. It's just not liquid enough. So as we add more and more expiration, expirations, it takes away from the liquidity on the option contracts. Overall, the more choices you have, the more the volume is going to be spread out. So I don't like the fact that we're getting to the point that we're going to just daily option contracts. I think it helps the market makers and it hurts the retail clients personally. But here's where we're at. 348.57, 348.50. There we go. At the money. Let's do the 355. We're going to buy this one. We'll go up 15 points. We did 20 points wide in the longer term option. Let's save a few dollars. We'll go 15 points wide. It'll be a little bit cheaper. Buy this, sell this twice. And then 5 points, 15 would be 7. And I guess we could do 7.5. Let's try 7.5. There's about, what is that? 40 cents. Not quite 40 cents in the middle. And buy this one. So now we're 325. We put the first trade on for 470. This one's $3.25. 750 is what it would be above and beyond the strike. Send it to the what if calculator. Pull this down. So above and beyond, we're looking at making 423.50 at expiration if it gets to that level. If we go anywhere above this, it would be this net debit minus 7.5, based off. I think they grabbed the. They got 50 cents in there, so they must have grabbed the 325. So at this point in time, 423.50. If we blow through the strikes all the way up to the 377.50 strike, if we go right out at expiration, we're talking about $1,162 approximately, if I could get it right on there. If it went right out at the strike price, ideally what we'd like is for the company to announce earnings and it lands somewhere in here and starts drifting this way over the next 2 days. We're looking at the 24th as the expiration date. That's trading for $325. So for every 1x2x1 open wing butterfly that we're looking to execute, we would have $325 of risk. If the stock stays here or goes lower, that's our maximum that we can lose on the trade. And we'll send this one down to the trading floor. We'll do it at 325. Boom goes the dynamite. Order has been sent. Wow, we executed very quickly on that one. So let's go back and review our 2 trades. And let's look at the orders here. We have it didn't execute yet. Okay, this is still open. And in the paper trading account, I'll have to probably adjust it. I always send them in at the midpoint whenever you're entering trades, like to focus on the midpoint and then adjust from there. You're going to work the order a little bit, especially around earnings, especially if you have multiple legs on any of the trades. So here we have the open wing butterfly using this Friday's expiration. And then we're going to look at ConocoPhillips, COP. We're going to sell a shorter term option with a higher strike, the 122, buy a longer term option that expires after the earnings report, which is the 121 strike, and we'll be long that. Hopefully this option expires worthless and we can ride this long call into that earnings trade, and hopefully we get a good report. ConocoPhillips is in the process of a breakout right now. If it hits 122 over the next 9 days before the 31st expiration, you just want to get out. If you're just up a dime, a quarter, 50 cents, just don't let this option contract get in the money. Close the trade out and just move on. And if you want to buy a call option going into the earnings, don't worry about it. You can also roll this. If this option contract is right here, you can roll into a standard long call spread. When you have diagonal trades, there's just a lot of different options, but you have to trade them. You have to watch these trades. You can't get assigned early on the 122 strike or even at that expiration date. You can't allow that to happen. So you really don't want this to get in the money. You can roll if you want. You could roll up and out and use that same expiration as the earnings report, as the long call option. So there are a lot of different things that you can do with this trade. All right, orders are in. I don't see any other questions. Thanks for chiming in, Kevin. I do appreciate it, from Lakeland, Florida. I'm Brian Overby from Charlotte, North Carolina, and we're going to call this a day. So on Friday, we're going to have Fundamental Friday. We've been working on a wheel strategy in Netflix, and we'll continue to manage that position. And we'll look to add a few more basic trades on Friday. Please tune in and let people know this is a basic seminar on option trading, and we have a whole fundamental video set that we send out if you sign up for a Trader account and use the paper trading app. And then we will be back on Monday and we'll look at the COP trade and we'll see how Google did. So thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.